because developing countries can have their own banking system based on many small local banks. They will have growth and prosperity, and you don't need foreign money, because actually foreign money never enters the borrowing country. So it's always a trick. It's one of the rules of banking. Let's say it's a developing country, let's say South Africa, and they're told, oh, we need money. We don't have enough savings. We need the savings from abroad. Okay, we'll take a loan from Barclays in London for £500 million. Okay, they tell us that's what we need. Okay, well, where does Barclays get this £500 million worth of money from? It creates it out of nothing. Credit creation through the banks. Now the South African Finance Ministry says, well, actually, we want to use this money in South Africa. So Barclays, send over the money. Oh, you mean you want South African rand? Yeah, sure. Well, we can arrange for that. There'll be some costs, and FX and whatever fees, but we're happy to do it. So what happens next is Barclays calls around South African banks. One of them may be a subsidiary of Barclays. It doesn't matter, but South African authorized licensed South African banks, you see. Why? Because they're the ones that have their accounts in South African rand. Barclays can't create South African rand. And they will ask for a quote. We want to sell pound and buy South African rand. What happens next? The South African bank will create that money out of nothing, which is something South African banks could have done without the round trip abroad, which indebts the country. And usually you debt for equity swap, or you can't pay your debt. Well, we own you now. We own your assets.
That's exactly right.
And that's been the trick. So